Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Carnival has been one of the really great recovery stocks of 2023. The stock is up 35% as I'm recording right now. It was up nearly 100% earlier this year. And that's on the back of really rapid improvement in the company's operations. Carnival reported record quarterly revenue last fiscal quarter and is now free cash flow positive, starting to pay down debt. So there's a lot of really great operational momentum, but there's still the overhang from about $25 billion worth of debt that the company had to take on just to get through the pandemic. And that's really the core challenge for the company is, are they going to be able to get back to free cash flow positive, paying down that debt and actually returning money to shareholders? And right now the narrative is yes, but they're using a really interesting and very risky trick to pay down debt. They paid down about $4 billion. So I want to get to the numbers today, give you the full picture of what is going on with Carnival's debt, where their cash flow is actually coming from, and how they're using that cash flow to pay down debt. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I'm going to get to the financial statements in just a second, but I want to give a broad overview of what is going on at Carnival and what has changed in the last 5 or 6 years. This is a chart of the company's total debt, and you can see here the total debt is now about $33 billion, just a massive debt load for any company. But you can see at the top right corner of the chart here that debt is starting to come down. It's down about $4 billion from its peak. So that's a really positive sign. And why is that happening? This is a look at the company's net income and free cash flow. And this is on a quarterly basis. So this is not trailing 12 months. This is just a single quarter. And you can see that in the most recent quarter, Carnival had about $1 billion of free cash flow and $1 billion of net income. So really positive operating trends there. That's exactly what you want to see from a company like this. But here's where we get to the questions. And I have 2 questions for Carnival. Basically, can operations get better? Can they improve occupancy? Can they raise their prices and actually improve that cash flow number? Or are we at a peak? And then are they going to be able to pay down debt? Let's answer that first question first. This is Carnival's most recent quarterly report. And there's a couple of numbers that really popped out to me. One is this occupancy percentage. Now, what cruise lines do is they say that their occupancy is a certain number based on double occupancy or 2 people per room in the cruise. If you have more than 2 people on average per room, then your occupancy can be over 100%. It's not unusual for occupancy to be over 100%, but 109% is extremely high. You can see that a year ago it was 84%. In the first 9 months of the year, it was 100%. So we are kind of hitting a peak there from an occupancy perspective. The other thing I want to note is per diems. This is basically revenue per passenger on the cruise line, charging about $200 in net per diems, and then the gross per diem, $90.45. Both of those figures are significantly higher than 2019. Now, that makes a lot of sense. There's been inflation, there's been increases in prices all over the place. But the question is, how far can you push this? Can they raise prices another 10, 20, 30%? That's what I really question. So it's very possible that there's going to be able to increase revenue, increase the revenue per user, and therefore increase cash flows, but probably not a lot from where they are right now. So I think we need to temper our growth expectations. That's the first piece here, is that operations have been getting better rapidly, but that line that I showed earlier of cash flow is not going to be going up and to the right forever. It's going to definitely level off. Now let's go over to the income statement and statement of cash flows and balance sheet. I'm going to go through a few things on each of these. The first is just the income statement. You can see that things are getting better very rapidly, $1.07 billion in net income. And that's on a sharp increase, $2.5 billion increase in revenue. So really positive trends there. The other thing I mentioned that we really want to keep an eye on is the balance sheet. So let's look at the liabilities or the debt on the balance sheet. Short-term borrowings is the first line in blue. Second is current portion of long-term debt. That's debt that's due within a year from right now, $1.8 billion. That is down pretty sharply from $2.4 billion and then another $200 million on top of that just in November of 2022. So that's part of the debt that is coming down. Remember, I said that earlier that debt is down about $4 billion from its peak. Long-term debt, $29.5 billion, down from $32 billion in November. Debt is down about $2.5 billion in the first 9 months of this year, the fiscal year, but there hasn't been $2.9 billion worth of free cash flow. So that's what I want to dig into. And to do that, I'm going to go up to the cash flow statement. And the cash flow statement that they report is for the first 9 months of fiscal 2023. So end of November 2022 through August 31st, 2023. Net income was actually a loss of $26 million. You add back things like depreciation and amortization, any changes in receivables, customer deposits, $1.1 billion. Keep that one in mind because I'm going to come back to that. So in total, operating activities has added $3.4 billion worth of cash to the balance sheet. Most of that cash is not earnings, it's things like depreciation and amortization and customer deposits. So money that they will earn in the future. Where is that money going? Well, there's purchases of property and equipment, $2.6 billion. So almost all of the cash that has been generated from operations. And then two really big numbers on the financing piece of the cash flow statement. Principal repayment of long-term debt, $6.8 billion. And then proceeds from the issuance of long-term debt, $3.0 billion. So they've issued some new debt to pay down old debt, but they've actually paid down significantly more debt than they've taken out. So on net, debt is actually falling for Carnival. But I want to go back up to the balance sheet and talk a little bit more about this customer deposits number, because this is something that we really need to keep an eye on. Again, on the left-hand side is the August 31st numbers. And this is, remember, balance sheet is going to be a snapshot of a single day in time. The customer deposits that Carnival collects, what you do is you get cash, but then you have a liability. So there's no real change in the operations. You don't get to keep that money. If somebody cancels their trip or you don't perform your duty as the cruise operator, then they get that money back. So that's why it is actually a liability. So those customer deposits come in as cash, and then a liability is added to the balance sheet. Nearly $6 billion worth of customer deposits Carnival has taken in and is just sitting on the balance sheet. So you would think that there would be $6 billion of cash to offset that, right? There's not. There's $2.8 billion worth of cash on the balance sheet. So where is that extra cash going? Well, it's going to pay down debt. Carnival can do this because it has what's called a negative cash conversion cycle. A negative cash conversion cycle is when cash comes in the door before you have to spend cash to earn that revenue. A great example is a grocery store. If a grocery store sells you a banana for $1, let's say, you pay for that banana right now, as soon as you get the banana. But that banana may have come in the door yesterday, and they're probably not going to pay for that banana for 30, maybe even 60 days, depending on their terms with their suppliers. If they're on net 30, that means they pay their supplier 30 days from now. If they're net 60, that means they pay them 60 days from now. So the grocery store gets money today, but it has a liability on the balance sheet that it doesn't have to obligate for some period of time in the future. That's exactly what cruise lines are doing. When you put a deposit down on a cruise, you pay cash today, but you're not actually taking that cruise for months, maybe even years into the future. So as deposits go up, that is Carnival's balance sheet. But eventually, they're going to have to perform those obligations, run the cruise, and actually spend money to do that. So they're kind of taking money out of the piggy bank to be able to pay down debt. Now, this might be the right thing for them to do financially because they do have very high cost debt. Some of the debt that they took out during the pandemic was 10, 11, 12% interest rates. You want to pay that down as quickly as possible, and they're maybe buying some of that back at a discount. But what I want investors to keep in mind is that this is something that is not going to be sustainable in perpetuity. If they have paid back $4 billion of debt in the last year, let's say, that doesn't mean that they have enough cash flow to do that in the future. So you need to have those operational improvements that I talked about earlier. Those need to continue. And you need to have this negative cash conversion cycle, basically growing the business, growing deposits. Because if that negative cash conversion cycle flips and now deposits start going down, now you're going to have to pull cash off the balance sheet in order to pay back customer deposits or perform your obligations as a cruise operator without as much money coming in the door. So there's a lot of moving parts here, but as Carnival's stock really starts to come back, I think investors really need to keep in mind what the risks are that remain with the business. This is still a company with about $30 billion worth of debt. Yes, they are paying it back, but they are in part using customer deposits to pay down that debt. So that's a very risky and not necessarily sustainable way to reduce your debt long term. This isn't a stock that I own just because I think the risks are too high given this debt level. But if they can continue to raise prices and improve cash flow, this could be a great recovery company. So let me know what you think of Carnival. Don't forget to check out fool.com/ASYM and sign up for asymmetric investing here on YouTube. Thanks for watching, everybody. See you here next time.